Welcome to the Roundup, covering what's important to accountants and advisors across July. Inside this month, the new small business energy incentive, the exposure draft legislation that's been released. We'll also look at the new property subdivision guide from the ATO. But first up, the Treasury consultation paper that's been released on the tax residency of individuals, looking at simplifying it down to a bright line test. Now, this is not the first time that we've seen a consultation of this type. Michael, what can you tell us and where are we up to with this?
Yeah, so Treasury has released over the last month a consultation paper focusing on the residency rules for individuals. And this has been quite a protracted process because this kind of dates back actually to some work that the Board of Taxation commenced way back in 2016. The Board of Taxation basically undertook a self-initiated review of the Australian residency rules for individuals, kind of on the premise, I guess, that the rules were fairly complex and difficult to apply in practice and were possibly a little bit out of date. And what we then had was a series of reports being prepared and provided to government on ways maybe to improve the way that those residency rules operated. And we actually saw a series of reports being provided to government and a bit of back and forth between the government and Board of Taxation. Well, without going through the full history of that, what we've seen, I guess, more recently was back in May 2021. The government at the time in the federal budget basically said that they would effectively adopt a lot of the board's recommendations in modernising and updating the tax residency rules for individuals. So that was a feature of the budget just over 2 years ago. Well, since then, we haven't really heard much in terms of what's going on in that space. We've had a change of government as well, and so it hasn't really been clear where things stand. Well, we've now got this consultation paper that's been released by Treasury, effectively reigniting the process, but we're not necessarily going anywhere. And let me just explain what I mean by that. The consultation paper draws from effectively a 2019 report that the Board of Taxation put together with a suggested way that the residency rules might work. And we'll have a look at what that is briefly in just a minute. And the government effectively, as part of the budget, seem to be willing to adopt a lot of those recommendations. Well, because we've had a change of government, we've had COVID that's kind of happened in the meantime as well, and some of us have been aware that that has made some residency issues quite difficult to deal with. Treasury is just wanting to kind of double check whether that proposed approach is really the best way to move forward with effectively. So, if we had another COVID type situation, would these rules be robust enough to deal with something like that, an event like that? And so really Treasury is, I guess, re-questioning whether this proposed model would actually work. Would it make life simpler? Would it be a good balance between simplicity and integrity, I guess, around the Australian tax base as well? So a lot of questions that Treasury has raised as part of this consultation paper, but very much drawing back to the board's recommendations. Now, in terms of those recommendations, basically what the board is suggesting is that we start off residency discussions with a simple black and white bright line test, and it is basically a 183-day test. If you meet that 183 days physically in Australia during an income year, then you will be an Australian tax resident no matter what else. So a very simple bright line test of residency, which is, I guess, the primary residency test. Now, if you do not meet that 183-day test, then the second step would be looking at a government official test. So some of you might be aware we currently have a superannuation test, and it's really aimed at government officials who are working overseas, and they're meant to be deemed to be Australian residents while they're performing that work overseas. Well, that test isn't very effective anymore because it's based on active membership of very specific Commonwealth superannuation schemes. Basically, that's not open to new members anymore. So the test is basically obsolete in large respect. So this recommendation would be to reignite that test, reinvigorate it, and basically ensure that Australian government officials working overseas will be treated as residents, but without there being any specific link to Commonwealth superannuation schemes. So they would be the first two tests, very black and white in terms of their approach. You're either a resident or you're not under those primary tests. Now, if you are not a resident under those two pretty black and white tests, then there are some secondary tests that will be used to determine your residency status. So even though you've been in Australia for maybe less than 183 days during the year and you're not an Australian government official, you could potentially still be treated as a resident of Australia. And there are a series of tests that you would look at. Now, the way those tests work just depends on your scenario. Were you a resident of Australia last year or not? Well, that will impact on which pathway you go down. If you have previously been an Australian resident, how long have you been an Australian resident for? And the recommendation is looking at a 3-year time frame for that. If you've been a resident for less than 3 years, well, it will be slightly easier for you to break Australian residency when you leave. If you've been a resident for, say, more than 3 years, it will be a little bit harder for you to break your Australian residency. You need to basically do more to cease to be an Australian resident. But the idea being that the tests that would be applied would be fairly straightforward. They would not require a detailed analysis of all the facts and circumstances. There would be a series of quite specific tests, that the idea being that you could pretty much work through that process without it being too costly or convoluted, basically. So that's effectively I guess the plan. But Treasury is wanting to test whether, I guess, there is still appetite for that sort of approach, whether it still would be robust enough given what we've seen happen around the world over kind of recent years as well. So there is no guarantee that this will ever see the light of day. This is a retesting of whether this is the approach that we should be moving forward with, or whether it should look a bit different, or whether we just stick with what we already have. So we really don't know whether this is going to end up, but this is, I guess, again, another step one in determining where the Australian residency rules might be heading.
Is there anything else that we should be aware of in this residency space?
Yeah, there's probably just two things to just keep in mind when we're thinking about tax residency. The first one is just a reminder that the ATO has finalised its updated tax ruling on the existing residency tests. It seems a bit odd that in some ways that the ATO has spent all that time and effort updating that ruling when we may well see a complete change in the way the residency tests operate. Although having said that, that process may or may not proceed, and if it does proceed, it might still take a fair bit of time to actually work its way through. So I guess in the meantime, we do have a more modern and updated tax ruling that we can refer to. And that tax ruling has a significant number of examples contained within it. And at least now we have, I guess, one place to look for, I guess, a lot of the guidance that we'd be looking for in the residency space. So don't forget that that's there. We're referring to it all the time in terms of help desk questions that we're getting on residency status. It is the go-to reference point now for residency issues when it comes to ATO guidance. The other thing just to be aware of briefly is corporate tax residency. So what we've talked about so far is all around the individual residency rules. What we're still waiting for really is some sort of update on what is going to happen with company residency. This is another area where the government had suggested a little while back that there would be some changes. And again, this is something that's been taking quite a while and we haven't really seen a whole lot of progress yet. For some people, changes to the company residency rules are as important, if not more important, than updating the individual residency rules. And I think there is a bit of frustration out there in terms of not seeing any real progress when it comes to what are we going to be doing around these corporate tax residency rules. So look, there's not really much to say on that other than we'll keep you updated. If we do see some further updates around corporate residency and what might be happening with the rules in that space, we'll certainly let you know. But in the meantime, we're just waiting to see what the government decides to do and what approach they're planning to take in that area.
And you can join Michael on the 11th and the 18th of September for the Tax Residency of Individuals web series that's coming up. Look out for that on the Knowledge Shop website. Also from Treasury this month, of course, we've got the exposure draft legislation that's been released on the small business energy incentive. Matthew, where is this coming from?
Yeah, well, we just had a budget a couple of months ago, and one of the key measures in that particular budget for small businesses is this new small business energy incentive. So that's where this is really coming from. And now we've got some draft legislation just released this month for consultation. Now that consultation period is relatively brief because it's come and gone now, and that consultation period has actually finalised and it's finished. But putting that aside, this measure might look quite familiar to many of you because it's quite similar to the two small business boosts that were just recently passed. And what the government's trying to do here is provide a bonus 20% additional deduction when certain small businesses go out and buy eligible depreciating assets or spend money on qualifying improvements on depreciating assets. Now, with that bonus deduction being subject to a $20,000 cap. It's really only intended to apply to the 2024 income year. So like those two other small business boosts, it's really a limited time concession. It's also only intended to target small businesses, but using a group annual turnover of less than 50 million. Now, the underlying intent of this measure is that it's really aimed at assets that help support electrification or energy efficiency. So the government is trying to encourage certain businesses to go out there and buy depreciating assets that help them move towards using electricity as opposed to fossil fuel, or using energy, using electricity more efficiently.
Do we now have an idea on what this is intended to cover?
Well, yes, we do, but let's just keep in mind that this is draft legislation. So it may well change, and certainly there's no guarantee that it'll be introduced or passed at all. But having said that, it looks like there might be a fair few things that are within scope at this stage. Just remember, this measure is intended to help with electrification. So if a business, eligible business, goes out there and buys a depreciating asset that uses electricity, and there's a reasonably comparable new asset that's available in the market that uses fossil fuel, it looks like those types of assets will be covered. And the draft legislation materials do give us an example of a business going out there and buying a reverse cycle air conditioner instead of a gas heater, and that would be covered. This measure is also intended to support energy efficiency. So if a business buys, again, a depreciating asset that uses electricity, and it's more energy efficient than the asset that it's replacing, it looks like that's within scope. And if it's not replacing an asset, it just does need to be more energy efficient than a reasonably comparable new asset, again, available in the marketplace. At this stage, it looks like there's a third category, a third umbrella of depreciating assets, and I guess I'd call them energy enablers. It looks like that's going to cover energy storage assets like batteries, or otherwise depreciating assets that help with demand management or help improve energy efficiency. So things that might be covered under that particular umbrella are devices that help monitor energy consumption, or devices that help switch on electrical devices during off-peak hours. So those types of assets look like they would be covered. Also at this stage, there's a whole bunch of exclusions. I'm not going to go through all of them, but I think the main ones are it's not going to apply to capital works. That's because this measure is really targeted at depreciating assets. It's not going to apply to assets that are predominantly used to generate electricity. So it looks like solar panels are out. And it's also not going to apply to vehicles, and that includes hybrid vehicles or electrical vehicles. And that's presumably because there's some other incentives that target those types of electrical vehicles. Now, like I said, this is all draft legislation. So again, there's no guarantee that it won't change, and certainly there's no guarantee it'll get passed, right? But I don't think that should necessarily stop us from having a discussion with our clients and just giving them a heads up that there's potentially something coming down the line, that there are some potential bonus deductions where they're an eligible small business with a group turnover of less than 50 million, and where they go and buy some eligible assets that help with supporting electrification or helping them with their energy efficiency.
And from the ATO this month, a helpful new guide on property subdivision. Michael, can you tell us a little bit more about what the ATO is covering?
Yeah, so many accountants would have been involved with clients who have got themselves involved in property projects, whether that's subdivision, construction of dwellings, that sort of thing. And there has been for many years some guidance out there in terms of how do we approach things like that from a tax point of view. And in fact, back in 2018, the ATO published a draft guide which was intended to be released in final form quite soon afterwards. It was released in draft form just to receive some comments. But unfortunately, that draft guide, the final version, never saw the light of day. The draft guide was archived. It was never finalised, and we've kind of just been wondering in the meantime, well, what's the ATO planning to do in this space in terms of guidance? Well, I'm not sure, but it's possible that the guides that we've seen released over the last month possibly are the replacement for that guide from all those years ago. These guidance from the ATO is very much focused on the small scale and small scale sort of subdivision and fairly small kind of construction type projects as well. And what the ATO is basically doing in fairly easy to understand language is basically walk through some of the key tax considerations when clients are involved in subdividing property and involved in some construction work as well. And the ATO is looking at that from an income tax point of view. So are we dealing with something that might be a business? Is it on capital account, or is it an isolated profit-making undertaking that might be taxed on revenue account? And depending on which category we fall within, how you might approach that in terms of a calculation perspective as well. And the ATO also looks at some of the GST issues that kind of sit around that as well. And what we find is that there's often a bit of consistency in terms of the income tax side and the GST side. Kind of the GST treatment will often, we find, follow what we've decided from an income tax point of view. And by and large, the ATO guide kind of reflects that understanding. Now, in terms of ATO guidance, one of the things I really like about this guide is that it really focuses in on and properly discusses the 3 different ways that you can be taxed when you're involved in a property project. I think a lot of people are aware that property developers may well be carrying on a business, and we might be dealing with trading stock rules. You may be doing something that is a kind of a one-off subdivision to maybe a private property, and it may well be just a mere realisation of a capital asset taxed on capital account. But the third option, the third category, I guess, is one that is sometimes overlooked a little bit. And that is this notion of something that goes beyond the mere realisation of a capital asset, but it's not repetitive, and so it's not a business activity, but it sits somewhere in the middle, and it might be an isolated, maybe one-off, profit-making undertaking that is still taxed on revenue account in a way, or in a sense, a little bit similar to the way a business transaction might be taxed. And it's that category that has maybe failed to receive enough attention in the past. And we've certainly found it very difficult to find good quality ATO guidance that deals with that category in a public space, I guess, particularly around the practicalities of it. How do you actually, for example, do the tax calculations? That's the bit that's been missing a little bit. There's certainly been guidance from the ATO on isolated profit-making undertakings, but it's just lacked that extra bit of practicality. And this guide kind of goes some way to addressing that. So you will find in the ATO's guide an example of a situation where someone holds a property on capital account. They decide to undertake a project which basically involves that property being contributed onto revenue account. But it's not a business activity, so we're not dealing with the trading stock rules. But the ATO works through, well, how do we calculate the profit that's taxed on capital account and the profit that's taxed on revenue account? How do you actually work through that process kind of step by step? And that's something that I quite like in this guide, because it's something that we've certainly found very difficult to find clear guidance on in the past. You can certainly go trawling through private rulings and you'll find this sort of stuff from time to time, but this is a guide that's on the ATO website, much easier to find and fairly easy to follow. So the guide does have some nice features to it. Again, if this is an area that you're not coming across all that often, I think it's a guide that you'll find pretty user-friendly in terms of how do we know whether something's revenue or capital, what are the factors that we need to take into account. And again, it's pretty practical in its approach, which I find is got a lot of good things going for it.
Is there anything else that's worth being aware of when looking at guidance in this area?
Yeah, there's probably 3 things that I would just briefly mention while we're kind of talking about this space. The first thing is we've got this ATO guide that deals with how do you know whether something might be revenue or a capital account, goes through typical factors that we would take into account, and that there are some examples in that guide. But what the ATO also did was release a separate document, and I'm not sure why it's a separate document, but it is, which looks at effectively 2 worked examples, looking at relatively small scale subdivision type projects. And the ATO kind of works through the process of, is this a business? Is it an isolated profit-making undertaking? And if it's not those two things, how do we deal with it from a capital gains tax point of view? And the two examples that are actually in that guide are both concluding that you were dealing with something that's actually on capital account. And the ATO explains kind of how they've got to that conclusion. So just be aware of that if you're looking at, I guess, the guide, which is looking at it from an explanation point of view, yes, there are some examples in there, but there is actually another document as well that is not quite linked, which provides further examples. And I think it's worth just being aware of the fact that, yes, there are other examples that the ATO has released, it's just they're not necessarily all in one place. So that's just the first thing to note. The second thing is, once you've figured out that income tax treatment, if it's revenue or capital account, we do need to be very careful with the GST treatment as well. Now, I said earlier that there's often some consistency between kind of the income tax treatment and the GST treatment. And what I mean by that is, if you're dealing with a property project that is taxed on revenue account, you will often find that there will be some GST implications. Now, that's not always the case. This is a bit of a generalisation, but you certainly will have a much higher risk of there being some sort of GST exposure. Whereas if you're dealing with a small-scale property project that is on capital account, in many cases you'll find that there is no GST exposure when it comes to that project. Again, there are exceptions to that, need to be very careful, but that tends to be how it plays out. Now, the ATO guidance does, at a very high level, kind of step through that, and you'll find that the ATO's comments are reasonably consistent with what I've just said. But again, just be aware that we're talking in general terms. You always need to do the analysis in a bit more detail. So don't forget the GST part. It is mentioned in the ATO guidance, but again, just pointing it out, we do need to be very careful that we can sometimes end up with some GST implications that are possibly a little bit complex. We start getting into things like maybe the margin scheme, that sort of thing, where we do need to pay a fair bit of attention. The other thing that I would just mention is that not all clients are involved in very simple and small scale property projects. There are certain things that can make our life a lot more difficult and make the analysis a lot more complex. And one example of that is clients who are involved in partition arrangements, for example. So you might have two or more parties who jointly own a property and they're deciding to undertake some sort of development, whatever that might look like. And at some point, they're going to split those properties up so that maybe one person has full ownership of lot A and another person has full ownership of lot B, that sort of thing. So they're splitting that jointly held property so that each owner now has full ownership of a specific lot or a specific unit or apartment, that sort of thing. That makes things a lot more complicated. So there certainly are scenarios where we might say they're on the relatively simple side from a tax point of view, but there are certain features of arrangements that clients get themselves into that can escalate, I guess, the complexity of the tax analysis very, very quickly. And they're the ones to be very careful about. And often in cases like that, as an advisor, it will often be necessary for a few parties to be working together to try and kind of figure out the treatment. And that would be the client, it'd be their accountant, it will often be a lawyer as well, and possibly a financial planner, just in terms of trying to figure out the full picture for the client. So be aware of that. Be aware of identifying where those complexities might be, and make sure that clients are getting the right advice from the right people as early as possible. Because we find that sometimes things get too far down the track before proper advice is obtained, and by then sometimes it's a little bit too late to kind of be all over the issues, and sometimes things have happened which maybe we would have done differently had we received that advice a little bit earlier. So it's certainly an area to be careful about. I think this ATO guidance is very practical. I found it quite easy to read and it's quite useful in lots of ways, but it's not necessarily going to give you the answer to all the fairly complex problems you might come across.
And that's the roundup for this month. And because changes are constant in the lives of accountants and financial planners, we'd love to show you what a difference Knowledge Shop membership can make. Why don't you give the team a call or jump onto the website and see why thousands of accountants and advisors across the country utilise Knowledge Shop every single day. We look forward to talking to you soon.